Hi everyone, my name is Muskan Arora and I'm a reporter at Markets Group. As market variables change, especially in equities both in the US and overseas, we have today with us the Chief Investment Officer of Blue Chip Partners, Daniel Dusina, to talk about his equity allocations, manager selection process, and strategic initiatives since becoming a CIO. Welcome, Daniel.
Thanks so much for having me on today, Muskan.
Perfect. Earlier this year, you got promoted to the role of CIO. What are the few things that you intend to change, and what are the few things that you won't change within both the investments and the team?
Well, it's interesting. So I joined Blue Chip Partners a little over 3 years ago, and I came on as the director of investments, and the role was really to centralize the entire investment process and investment side of the business within this wealth management firm. And so realistically, although it's a title change, my role isn't changing all that much. But what I will say is there are a continued focus that we have within the investment committee that I lead on processes. And so what I would say is, since the beginning of this year, we've kind of continued to focus on enhancing our process, because the way that Blue Chip Partners has grown and the way that we anticipate continuing to grow, one of the most important things within the different parts of the business is to generate scale. And the only real way to do that on the investment side of the business is to continue to have a rigid focus on processes. So, that includes things like more systematic ways to identify companies that would be of interest to us before we actually dive in deeper. That also includes, again, more systematic ways to identify on a firm-wide basis where we might need to initiate some rebalancing or tax loss harvesting. Really, it all kind of boils down to the process side of the equation. Now, what's absolutely not changing is our inherent investment philosophy. We're still going to be focused on high-quality businesses with an inherent focus on companies that can pay and grow dividends. We're really not changing who we are at our core, but rather the way I always explain what we're doing on the investment side is just to continue to enhance our process without altering our investment philosophy.
That absolutely makes sense. And how do your allocations abroad look like?
Yeah, so they look a little bit different than how we allocate domestically. So on the domestic side of client portfolios, we are building our own equity models internally. So identifying companies, building models from the ground up, generally between 25 to 40 equity securities on the domestic side. On the international side, we do outsource that. So we identify active partners, external managers that we believe align well with our domestic philosophy. And the reason that we outsource on the international side is just, quite frankly, there are different forces, different factors that play internationally than there are domestically. And we just don't feel that we have the level of expertise required to build a portfolio internally. And instead, we provide a pretty rigid focus on the due diligence process. So, what we are actually doing on the international side, I would say we are quite a bit underweight relative to what I would say our wealth management peers. You can look at even broad world indexes or target date portfolios. Like right now, our international allocation for a 100% equity portfolio is 8%. And we have that split between two managers. When we're looking at building an allocation like that, we want to split the ticket to stay diversified, but we also want to make sure that if we're splitting the ticket, aka using two or more managers, that they are going to behave somewhat differently. So we still want them to align with the philosophy that we have in place. Again, that's a focus on quality companies, upside participation, but a focus on capital resiliency. But we don't necessarily want those two external managers to be incredibly correlated. We don't want them to be moving in the exact same way. So again, like we're trying to identify active partners specifically that can behave and kind of coincide with one another. And the last thing I'll say is we do have a preference for active across the board, but specifically in international, I think that there is just a little bit less market efficiency, and that does show up in returns when you can identify managers that have consistently demonstrated good performance.
Absolutely. And what other factors do you keep in mind while choosing your allocations to make them worth your while?
Yeah, I think a lot of it is, well, let me take a step back. The first kind of like barrier to entry is just performance. It's not the be all end all, but realistically, the first thing I'm going to look at is trailing results. And not necessarily, was this manager able to consistently generate a top decile, level of performance, but it is some degree of consistency. So, for example, if I'm looking at managers that I think align well with our philosophy, I wouldn't necessarily expect them to shoot the lights out if you've got an international market that's kind of running through the roof. On the other hand, if the international market is struggling, broadly speaking, I would expect this manager to do a little bit better. But so by and large, what we want to see off the bat is just some level of consistency when we look at trailing results. And then from there, I like to again, the rigid focus on the due diligence side is really more qualitative than quantitative. So the performance is really just a barrier to entry. And then once you kind of are interested, that's when we'll dive in. I really, again, just like we internally, when we're building our own equity allocation domestically, are focused on, again, process. I really like to spend time with the team and understand the process that was involved to generate those trailing results. Because realistically, again, I said the importance of consistency of results. The consistency of results in the future can continue if the process is in place and it has worked previously. So I think I put a lot of focus there, and it can take some time, but realistically, we're making allocations that are very long-term in nature. So myself and my committee, we really don't mind spending, multiple months at a time on due diligence processes.
Absolutely. That sounds brilliant. And could you highlight a few red and green flags that you look for in managers?
Yeah, I would say, well, I'll start with the bad stuff. The red flags, one of the things I always ask for, just at the initial stages of due diligence, and this is true on both equity and fixed income portfolios, but I like to see at least 10 years of trailing attribution. So that's both year to date, 1, 3, 5, 10-year trailing attribution, but also calendar year attribution. So I can understand if those returns on a trailing basis looked interesting to me, like how did they actually get generated? Where did they come from? And one of the biggest red flags that you end up seeing is that this fund looks really good on paper because the returns were all coming from one or two names. And that's not inherently a problem, but it does just spark some concern because realistically, if that one or two decisions weren't made, all of a sudden this fund looks a little bit more average. And that's probably the biggest red flag. And then also, another red flag is, again, I mentioned how focused I am on process. Like I will generally catch up with multiple members of the team when I'm doing due diligence. If I get a different types of responses when I ask certain questions related to how their investment process actually comes to fruition, if I get different responses, that does tend to lead me to believe that, maybe the process that they market is really just that. It's marketing. It's not necessarily employed. And so, that to me kind of goes against ultimately what we're looking for. So there's just a couple of red flags. On the positive side, I would say you can certainly take the exact opposite of both of those two things. If you look at the trailing attribution over the last 10 calendar years and the returns are more or less well diversified from a contribution to return perspective, if you have folks that have been very clearly abiding by a rigid investment process, that's always nice to see. But then another green flag I would say is if you couple a kind of robust investment process that's been in place for a long period of time with actual managers that have been in place for a long time. Team turnover is another one of those things that can end up being a green flag, if you will. If you have not just portfolio managers, but also analysts that have been with the team or the specific strategy for a very long time. Again, going back to the importance of kind of consistency of results, the consistency of results can only really be possible if you have consistency of team, unless you get very lucky, of course. So I would say those are some of the most important things for me. And when I look at the initial stages of due diligence, those are definitely, I would say, red and green flags that I look out for.
Amazing. And how do you think the US presidential elections are going to change your equity investments both in the US and overseas?
Yeah, it's obviously a question that we're starting to get a lot more, just given
Yeah.
the timing of things. I wrote about this back in January on Blue Chip Partners blog. We just did a podcast on this. If you guys are interested in that, after watching this YouTube, you can hop over to Blue Chip FM, Blue Chip Partners, Family Media. It's on YouTube. It's on our website, all that. But the long and short of it is, I don't think this like election cycle as it pertains to markets is really going to be any different than any other election cycle. And what that general return experience is in election years is it's actually not much different than any other random year, going all the way back to the 1920s, if you're looking at full calendar year returns. But what is a little bit different is the volatility that you see. So specifically between the months of, call it May to August, think like Memorial Day to Labor Day here in the US, I think the average drawdown during that period, it is a seasonally weak period. So the average drawdown during that point, those periods in time in any given year is around 8.5%. In election years, it's closer to 9%. So, that just kind of speaks to the elevated level of volatility that I would expect to see. And you kind of layer in the fact that the domestic market really has run quite magnificently. If you look at 2023 coupled with the first 7 months of 2024, I mean, there's a lot of room for some market taking a breather, if you will. So when you layer in the kind of, emotional trading that ends up happening around elections, you get debates that start heating up. They're talking explicitly about certain sectors, whether it's healthcare or energy. I think it's really, really likely that we see continued volatility in some of those types of sectors that are in the hot button spaces, that the delegates are talking about. But that doesn't necessarily, for me, change anything around long-term investment theses. I've just been advising individuals and clients of ours to be prepared for some volatility. That doesn't necessarily mean it's doom and gloom for the entire year or the next 12 months to come, but just don't be surprised when we get some choppy trading.
Absolutely. And you have three different types of equity core models. What are the major sectors that you eye through those?
Yeah, so, as you mentioned, we do have three equity models. They're all based on, our flagship equity model is the core model. And then we have one that's a little bit more aggressive and then one that's more income oriented. So realistically, they all are well diversified generally across the 11 gig sectors. There might be points in time where we aren't allocated to a certain sector, but generally speaking, we're allocated across 11 gig sectors. But the difference is, I would say, in how we kind of build the portfolios. So I mentioned those three do have a little bit of a different outcome, I would say, that's desired. And so we build the portfolios as such. So the core equity model, again, it's well diversified across the sectors, but the focus of that model is upside participation, but really more of a rigid focus on capital resiliency in equity markets. So again, just like I talked about with the international space, if you have a market that is running amazingly hot, kind of like the S&P 500 cap-weighted index has this year, we're not going to keep up with that. We're not expecting to keep up with that in its entirety, and that's okay. But when you have years like 2022, in which the S&P 500 cap-weighted index is down, 18.5%, I would expect us to be down significantly less than that. So that's really the focus of the model. And more formally, in that model and really all of our other models, we more formally bench to the S&P 500 equal weighted index.
Okay.
Because given how the domestic market has developed over the last 10 years, and also given the fact that I wouldn't build a portfolio with close to 15% of a client's holdings in just 2 or 3 names, that's not the cap weighted index is not an appropriate benchmark for us. Whereas the equal weighted S&P 500, in my view, is a much more accurate representation of the market. And so, we build and monitor and bench the portfolio accordingly. The more aggressive allocation that's based off that core equity model, it's called the core growth advantage model. Yeah, the only real changes that we make are just either replacing existing holdings with something that we view as a better long-term growth candidate, with potentially more volatility along the way, or supplementing, the existing set of holdings with other names that aren't necessarily a good fit for the return experience we're trying to generate for the core model. Again, I mentioned that rigid focus on capital resiliency. But for those folks that have a multi-decade time horizon and can stomach a little bit more gyrations in their portfolios on the equity side, with the potential for greater long-term gain, like those are changes we're going to make. So it's some replacements, some supplements, but really the goal there is still diversified across sectors, but just a little bit more juice to it. And then finally, on the income side, it really is the same thing. So for example, in our process, we do have a bit of an inherent focus on dividend payers, but more importantly, dividend growers. So it's not like every single company in our core equity model has to pay a dividend, but the vast majority of them will. And we try to keep our kind of non-dividend payer bucket pretty minimal. But so let's just say, for example, if we have 3 non-dividend payers in the core equity model, in the core income advantage model, that income-oriented version, that's not going to get allocated to any of the non-dividend payers. And instead, we're going to replace that weight with securities that are highly income generative. Those could be single companies, they could be ETFs, funds, et cetera. And then the other thing that we do is in that model, 75% of the allocation is the core equity model, X any non-dividend payers. And the rest of the allocation, that 25%, is allocated to highly income generative securities. Again, that could be stocks, it could be ETFs, funds, whatever. So all 3 models are well diversified across sectors. The actual makeup can look a little bit different, just given the things that we're adding and removing. For example, in the core growth advantage, you might see a little bit heavier of an allocation to tech and tech plus, things that are your kind of standard growers. And then on the income advantage side, you might see less of that, right? Just because of the presence of dividends and all that.
Absolutely. And within your equity portfolio, how would you say inflation and the Fed rates have impacted the way you make allocations?
Yeah, it definitely is a consideration, right? Because, if you look back from basically the period of the financial crisis up until 2022, you had the problem of inflation being too low, right? And so what that does to equity markets relative to where we are today is just a very different experience. I mean, it just changes the calculus when you're modeling out what your expectations are for a fair value of a company. So what I would say is, even though it's kind of like one of the components of our investment philosophy that is just inherent, by focusing on quality companies, like one definition of quality is companies that are a bit immune to pricing fluctuations, so they have pricing power, right? Like that would be one component of a quality company to me. But what the recent environment has done in terms of changing how we think about things is it's made the ability to have pricing power a lot more important when we're analyzing both existing and potential new holdings. So in an environment like this, where you have, for example, like even from 2022 until now, a lot of the growth that came out of your kind of standard boring consumer staples firms has come from just increasing pricing. You have negative volume growth, but you have 15% price growth, which basically shows up as organic growth, but is it really growth? It's just passing on higher prices to consumers. So like, you need to understand that when you're making an allocation. Like right now, it's really important for us to identify companies that do have pricing power, that are going to be those kind of mission critical items or services in the various spaces that we're looking at. And so it doesn't necessarily change how we operate, but it definitely increases the emphasis on one specific part of our analysis.
Absolutely. And before we wrap up, I'd love to ask you, what is something that you're doing contrary in your portfolio?
Yeah, it's a good question. I mean, I think even the fact that we are building our own models internally on the domestic side is a bit contrary. And, the other thing I would say is like the way that we kind of build the high quality equity model, the dividend growth orientation. I think people generally think of that as kind of like a value part of the style box. Dividend yield and value kind of go hand in hand. But We actually are explicitly trying not to be just a dividend value fund, if that makes sense. And that's because I don't think that the market today and going forward is going to look and feel the same way that it did the 30 years prior.
Yeah.
Meaning that I think it's really important to be well diversified across the style box. So that means finding companies that are on sale, right? Your classic value companies that by way of price decline end up having a high dividend yield. If they still have good potential for dividend growth and they're on sale, like that's a good opportunity. But at the same time, I think most dividend or quality oriented managers really don't venture out into the kind of growthier part of the style box. But in reality, there's a lot of companies out there in that realm that, have really good dividend growth attributes and really high quality attributes. But for example, their dividend yield might be really low just because the price appreciation of the stock has far outpaced any dividend increases that have happened. So something that we're doing that's a bit more contrary is not being afraid to venture out into that realm. Obviously, we do it in a manner that is appropriate for, again, the return experience that we're trying to generate. So that might involve a half position in a name that's kind of out on the growthier side of the spectrum, right? So its impact, should there be some downside, the risk is somewhat more minimized. But I think a lot of dividend-oriented managers wouldn't necessarily do things like that. But to me, just seeing how the market has changed and developed in recent years, I think that's almost necessary. I think it's table stakes at this point, because to be ignoring companies that fit your philosophy but don't fit some dividend criteria, I think is short-sighted, and I think it's checking a box just to check a box. So we try to avoid that, and that's a little bit different than I think a lot of folks in our space would kind of employ from a research process perspective.
Yeah, that's amazing. And I think that's all the questions I had for you. So thank you so very much for taking out the time and answering the questions. It was lovely speaking to you.
Likewise, Muskan, happy to do it, and really appreciate you having me on today.
No worries. It was my pleasure.